Hello everyone, greetings for the day. I, C. Ankit Bhandari, welcome you all at another episode of BCAS Tax Guru Cool. In this episode, we will discuss recent notifications, circulars and some of the important judicial pronouncements cited by our court. Let's first start with the circular. Circular number 10 dated 22nd May 2019, which speaks about condonation of delay in filing of Form 10B, that is Audit Report of Trust for years prior to assessment year 2018 and 19. CBDT directs that where delay in filing of Form 10B for assessment year 16-17 and 17-18 is on account that audit report has been obtained before filing of return of income and has been furnished subsequent to return filing of income but before the date specified under section 139 is condoned. Secondly, in all other cases which may be where audit report is yet to be furnished, Commissioner may allow belated filing of return of income if he is satisfied that assessee was prevented by a reasonable cause. However, you need to note one point that all such applications shall be disposed by 30th September 2019. This is really a very welcome move as many of the trusts has not filed their audit report due to some or the other reason. Moving to our correspondent, Mr. Pulkit, who will brief us about other notifications and circulars.
Sure, Ankit. Two welcoming changes in tax audit report made by CBDT. Clause 30C CAR and Clause 44 GST of Form number 3CD was kept in abeyance till 31st of March 2019, White Circular number 6/2018, dated 17th of August 18. Various representations were made to board that reporting requirements under clause 30C and 44 are onerous and may be deferred further. Consequently, the board has decided to keep the reporting requirements in abeyance till 31st of March 2020. The IT department has made changes in Form 16 and made it detailed from the assessment year 2019-20. I am highlighting the four important changes which are as follows. Number 1. Detailed breakup for allowances to be exempt under section 10 is required to be furnished in part B of Form 16. Such allowances are travel concession, death cum retirement, commuted value of pension, HRA and other such allowances that are exempt under section 10. Additional disclosures under section 16 is required, that is standard deduction, tax on employment and entertainment allowances. Additional details for claiming deductions are required to be furnished, for example section 80D, section 80G, section 80TDA, section 80CCD. Detailed disclosures regarding any other income needs to be reported to the employer, that is income or loss from house property and income from other sources. This would require a sea change in reporting requirements for employer while filing their TDS returns and employee while filing their income tax returns.
Thank you, Pulkit. It was really informative, especially for the salaried employees. Now it has really become important for salaried employees to file their return with due diligence. Now, moving ahead in our episode, it's time to get updated with recent judicial pronouncements. Recently, Honorable Supreme Court has given its verdict on 43B issue. Let's listen the glimpse of the decision from Ms. Shubhangi.
Thank you, Ankit. So here we have in hand a very interesting judgment on the case of Commissioner of Income Tax Ahmedabad versus Gujarat Cyclopets Limited. In this case, the assessee had taken a loan from bank on interest. However, the assessee did not make interest payments accrued during the year. Instead, it obtained a further loan from the same bank and sought to adjust the interest liability in the said loan. Further, it claimed deduction of such interest liability under Section 43B on account of the fact that now no interest payment is outstanding and that the amount is paid off. On assessment, the assessing officer applying explanation 3C to Section 43B disallowed the deduction claimed by the assessee and added the amount of interest in its income. Both the Commissioner of Appeals and the Tribunal allowed the claim of the assessee. The High Court, on further appeal filed by the Revenue, held that the Tribunal was right in law and treated the conversion of unpaid interest into a funded interest same as interest payment and dismissed the appeal of Revenue. On further appeal to Supreme Court by Revenue, it was held that as per explanation 3C inserted by the Finance Act 2006 with effect from 1st April 1989, the deduction is rightly disallowed by the assessing officer. Explanation 3C states, for the removal of doubts, it is hereby declared that a deduction of any sum being interest payable under Clause D of Section 43B shall be allowed if such interest has been actually paid and any interest referred to in that clause which has been converted into a loan or borrowing shall not be deemed to have been actually paid. So, referring to the above case, we can conclude that deduction under Section 43B can only be claimed on actual payment of interest liability and not on its conversion to funded loan. That's all from my side. Over to you, Ankit.
Thanks a lot, Shubhangi. This issue was already dealt by various high courts, and now we hope that after Supreme Court's verdict, it will attain its finality. Next case is very interesting as Chamber of Tax Consultant has challenged the administrative role of Commissioner Appeals. Whether Bombay High Court has given its decision in the favor of Revenue or the Chamber of Tax Consultant has succeeded in its plea. Let's hear it from Mr. Ravi, who has attended this case live.
Thanks Ankit for introduction and hello to everyone. Today I have a very interesting case in my hand, something not related to the section of income tax but the severity itself. The case is Chamber of Tax Consultants versus Central Board of Direct Taxes. Sometimes back, the severity issued a central action plan for the financial year 2018-19 for the purpose of setting out the targets for tax collection, fixing timelines for disposal of cases, and for awarding certain reward points for such disposals. However, since the said Central Action Plan proposed to incentivize CITs who were passing orders in the favor of government, it raised a huge issue and there were widespread protests against such a move. The Chamber of Tax Consultants and others filed a public interest litigation with the High Court on 2 points. First, challenging the allocation of reward points to CITs for passing orders in a favor of Income Tax Department, and second, to dispose of the cases pending before them within a fixed time frame. The petitioners contended that credibility in the functioning of justice delivery system and the reasonable perception of the affected parties are relevant consideration to ensure the continuous public confidence in the credibility and impartiality of judiciary. They cited the case of Dedicated Healthcare Services TPA India Private Limited versus ACIT. In the said case, the division bench, by referring to section 119 of the Act, struck down a circular issued by the civility on the ground that the same would interfere with the exercise of quasi-judicial discretion of the assessing officer. For the time limit, petitioner pointed out that section 256A of the Income Tax Act does not lay down a fixed time frame for the disposal of an appeal. Therefore, the severity via the said Central Action Plan should not attempt to shorten the time disposal of an appeal and lay down a rigid time frame to decide the appeal. Countering both arguments, severity argued that it had been formulating the Central Action Plan every year for purpose of identifying the core areas of the departmental functioning and setting targets therein, including that of CITs. The High Court held that in the first point, Severity's act of awarding the additional points for passing quality orders would amount to an illegal prescription, and therefore It should not be allowed to define the quality orders in a manner proposed in the said Central Action Plan. The High Court then set aside the relevant portion of the Central Action Plan that incentivized CITs for passing quality orders. On the second one, High Court held that setting out targets for tax collection would not render the policy arbitrary or unreasonable, and that in the absence of such norms, it could be extremely difficult to judge the quantitative performance of the persons concerned. That's all from my side. Over to you, Ankit.
Thanks, Ravi, for the wonderful insight. It was really a bold move from the petitioner, considering the definition of quality orders, which included enhancement of tax addition and application of penalty. This ruling will for sure save lot of taxpayers from undue harassment. Now I would like to further discuss how important it is to adhere with the procedures laid by the Act. Can a simple procedural default make the entire ruling invalid? Let's hear this from Ms. Kumkum, who has tracked the entire case since its inception.
Yes, Ankit, it is absolutely correct that procedure given under any law is very crucial aspect. As per section 260A subsection 3 of the income tax, where the High Court is satisfied that a substantial question of law is involved in any case, it shall formulate that question. As per section 260A subsection 4, the appeal shall only be heard on the question so formulated as per section 260A subsection 3. However, in the case of Rayatar Sahakari Sakkare Karkhane Niyamit, the Honorable High Court did not frame questions as required by section 260A subsection 3. Instead, all the decisions were taken on the basis of questions framed by appellant under section 260A subsection 2 clause C. Considering the above facts, Honorable Supreme Court was of the view that the High Court did not decide the appeal in conformity with the mandatory procedures prescribed in section 260A. Similar pronouncement was also given recently in the case of Principal CIT versus Messrs. AA Estate Private Limited. Therefore, considering it just and proper, Honorable Supreme Court remands the case to the High Court for deciding the appeal afresh to answer the questions framed above on merits in accordance with law. That's all from my side, and over to you, Ankit.
Thanks, Kumkum. And this case clearly shows that all the tax practitioners should take care of even minute procedural details while representing case in the courts. We all know that wherever deeming provisions come into picture, there involves an interpretational issue. Our next case involves an interesting issue under section 50C and 54 EC of Income Tax Act. Ms. Khushboo will highlight insights of the recent Bombay High Court judgment on this issue.
Hello Ankit. I have the insights of the case between Jagdish C. Dhavalia and ITO, pronounced by Bombay High Court. This case is based on section 54 EC read with section 48 and 50C. In this case, the assessee sold a plot of land for the sale consideration of Rs 25 lakh and invested the entire amount of sale consideration in the bond as specified under section 54 EC, declaring capital gain of Rs 21.19 lakh. As a result of investment, assessee claimed full exemption of such capital gain under section 54 EC. During the course of scrutiny, the AO determined the long-term capital gain of Rs 47.47 after considering the deemed valuation of the property. Further, the assessee is given full deduction of Rs 25 lakh as investment was made. Before the Commissioner appeals, the assessee contended since the entire sale consideration of Rs 25 lakh was invested in the specified bond, he must get full exemption of capital gain irrespective of the computation under section 50C. After the arguments given by the both parties, the Honorable Bombay High Court held that Section 50C must be given full effect, and the contention of the assessee is totally wrong. Section 50C states that the valuation by the stamp duty authority would be deemed to be the sale consideration of capital asset, replacing the declared sale consideration if it happens to be less than the stamp duty valuation. In any other interpretation, the provision of Section 50C becomes redundant. Anybody in this situation would take advantage by simply claiming to have made investment in specified asset equal to the full declared sale consideration. Summing up, for the purpose of taking exemption under Section 54 EC, in case the stamp valuation is higher than the actual sale consideration, then the latter is replaced by former in considering the full value of sale consideration. This is all from my side. Over to you, Ankit.
Thanks, Khushboo, for sharing such an interesting case. Now, last but not the least, can we revise our return beyond the provisions of Section 139 subsection 5? The first thought which comes into our mind is a big no. Let's hear it from Pulkit whether courts have a different opinion or it was just an open and shut case.
Good afternoon, Ankit. Here is an interesting case between Dalmia Part Limited versus Assistant Commissioner of Income Tax, which I would like to share with you all, where Madras High Court gave an extremely welcoming judgment. A company filed a revised return of income pursuant to the arrangement and amalgamation approved by the National Company Law Tribunal, Chennai. The company filed the revised return quite late because the process of amalgamation was in progress. The Income Tax Department was with the view that the assessee cannot file a revised return after the expiry of 1 year from the end of the relevant assessment year, which is in accordance with Section 139, subsection 5 of the Income Tax Act 1961. Therefore, the department drew the attention of the court to the fact that since the revised return of income have been filed beyond the prescribed period and continuation of the delay has not been obtained from the board under Section 119, subsection 2, clause B of the Act, and further the assessee has not complied with Rule 12.3 of the Income Tax Rule by filing the revised returns electronically, the department has rightly held the revised returns invalid. However, the assessee presents an argument that the department was trying to relate the case where the assessee discovers any omission in the original return and filed a revised return. But in this particular case, the revised returns have been filed pursuant to the scheme of arrangement and amalgamation approved by the National Company Law Tribunal under Section 391 of Companies Act 2013. Therefore, the arguments given by the department are not correct, as Section 139(5) is not applicable to restructuring cases, and this fact is well supported by Marshall Sons and Company India Limited versus ITO, JK Bombay Private Limited versus Newcastle. After the arguments presented by both the parties, the Honorable Madras High Court pronounced a judgment in favor of the assessee. The Honorable High Court said that there are reasonable reasons to believe that the assessee had no choice to file the return after the prescribed period as stipulated under Section 139(5) of the Income Tax Act 1961. In a nutshell, the approval of the scheme of arrangement and amalgamation under Section 391 of the Companies Act does not operate as a mere arrangement, but it becomes a statutory force and must be accepted by all the stakeholders. That's it from my side. Over to you, Ankit.
Thanks a lot, Pulkit. We have tried sharing recent, relevant tax updates and interesting case laws. Hope you have found this episode enriching and engaging. Please share your thoughts, suggestions and feedback in the comment section below. Stay tuned with BCAS Tax Guru Cool for more such interesting updates, amendments and knowledge sharing sessions. Thank you.